Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto, and in this episode, we're taking a close-up look at mortgage REITs. My guest today is Harsh Hemnani, Senior Analyst at Green Street, where he was instrumental in launching coverage of the mREIT sector, establishing the firm as a key voice in an increasingly important segment of the market. Harsh, welcome to the podcast.
Thanks for having me.
So, to start us off, can you give listeners a quick sense of the size of the mREIT sector, how it breaks down between residential and commercial, and the role that it plays in the broader economy?
Yeah, maybe I'll take the second part of that question first. And starting on commercial mortgage REITs. Commercial mortgage REITs provide a fairly simple value proposition. They're writing short-term floating rate loans on properties that are undergoing some sort of transition. So they're not fully stabilized. So if you take a step back and think about the overall commercial real estate debt markets, it's about a $6 trillion market with 90% of those loans coming from three big lenders: banks, insurance companies, and CMBS. And for various reasons, these three lenders really look at stabilized assets when they're underwriting loans. Mortgage REITs, on the other hand, they can come in and take some idiosyncratic property level risks and underwrite those better than the three stabilized lenders. So think about underwriting construction risk or lease up risk, or even think about a property that's being acquired and the acquirer plans to invest some capex into the asset and expects to see some sort of rent upside from that. These mortgage REITs can underwrite that business plan, that situation better, given their commercial real estate experts, and they can execute on the loan. And they also give borrowers the certainty in who their counterparty will be throughout the life of the loan. So think about a CMBS, for example, where the person underwriting the loan, the issuer, is going to be different from the person you would deal with throughout the life of the loan, the servicer, which creates a ton of uncertainty for the borrower. Mortgage REITs take out that uncertainty. That's the value proposition they provide to the commercial real estate market. So underwriting these more transitional properties, more idiosyncratic, and providing borrowers the incremental certainty. For that, they charge you a slight spread premium on their loans. Moving over to residential mortgage REITs, they think of themselves as prepayment experts. So if we take a step back, the US single-family residential mortgage market is about a $13 trillion market, with 75% of that market being in agency mortgage-backed security that are backed by Fannie. And these agency MBS make up the bulk of residential mortgage REIT assets. And so because they're primarily credit risk free, the biggest risk here is prepayment. If rates go down, borrowers can refinance their mortgage, leaving investors with a prepayment that they now need to reinvest in a lower rate environment. And so that leads to negative convexity in these mortgage-backed securities that the residential mortgage REITs are better positioned to underwrite and manage versus the bread and butter MBS investors, the biggest ones being banks and the Fed and foreign investors, who are really adding MBS for the primary reason that it has a somewhat better carry than traditional risk-free assets like treasuries. In terms of size, commercial mortgage REITs are about a $20 billion market cap in aggregate. And then you compare that to residential mortgage REITs, which are in aggregate about twice the size of that, so about 40 billion. And just to put those numbers in context, if we compare that to the equity REIT market, that's multiple times the size at about $1.4 trillion.
And how would you describe the environment that mREITs are operating in right now? What do you see as the big macro forces that are having the greatest impact on performance?
So the backdrop for commercial mortgage REITs is fairly healthy today. If you think about commercial real estate credit, it's fairly attractive on a risk-adjusted basis. Property values have declined roughly 20% from their peak. They seem to have stabilized. So the risk of a broad-based property value decline from here is fairly low. And if you put that in context of where expected returns or spreads on new loans are, they're roughly in line with their long-term average. So what that makes for is roughly average risk with well below average return on these loans, which sets up a very attractive risk-adjusted return backdrop. Another way to think through relative value of these loans is comparing it to corporate credit. Corporate credit spreads are pushing all-time tights, whereas commercial real estate spreads are roughly in line with their long-term average. So the relative value between commercial real estate credit and corporate credit is also very attractive. And the last thing to think through is that mortgage REITs, they can stay in the safer end of the risk spectrum today while still earning their return targets. And the reason this is happening is very interesting in the market today is borrowers that had loans in place that were taken before the recent rate hike cycle and are refinancing into new loans are kind of hesitant to lock in long-term tenure loans at today's cost of capital. And so they're essentially using these floating rate loans that are provided by market REITs as a waiting point almost before they lock in long-term capital at rates that are more appetizing for them. Another thing that's playing out at the same time is because those pre-rate hike loans were at lower coupons, refinancing into a new loan would lead to higher interest expenses. And even NMI has remained healthy on the property. The higher interest expense itself would put pressure on debt service coverage ratios. And the stabilized lenders, banks and insurance companies specifically, have very stringent debt service coverage ratio minimums. And not all borrowers today can meet those. And so they're quite these more flexible alternatives and finding their way into mortgage REIT portfolios, where mortgage REITs can now underwrite almost stabilized properties while still generating the same returns on a spread basis that they have been able to previously on transitional properties. So that's setting up a very healthy risk return backdrop for mortgage REITs going forward. On the residential mortgage REIT side, again, the biggest asset that they own is agency MBS. And given that these are credit risk free, the biggest risk is prepayments. So if we take a step back and look at the prepayment backdrop, borrowers today are prepaying a lot faster than they were pre-COVID. There's a few things driving this, but one of the bigger things driving this is 2023, 2024, and even 2025, a lot of borrowers bought homes and took 6% or higher coupon mortgages, hoping for rates to come down and that they would refinance it to a lower coupon mortgage. However, the rates have not come down yet. And that's put some strain on household finances, and borrowers across every refinance incentive are prepaying quicker today than they were pre-COVID. So historically, a rule of thumb in the mortgage industry used to be that you need to give borrowers a roughly 50 basis point refinance incentive. So you can think of that as if you have a 6% mortgage rates now need to fall to about 5.5% before refinance start to accelerate. Today, that number is closer to 25 basis points. So if you have just a 25 basis points refinance incentive, pre-COVID speeds are starting to accelerate quite a bit. So we're in an environment where borrowers are prepaying quicker, and what that's leading to is a little more negative convexity in the mortgage market than we historically see. Another thing to think through on the residential mortgage REIT side is just market spreads. So entering this year, market spreads were fairly wide relative to their fundamentals. So the biggest driver of potential market spreads is rate volatility. And one way to think through this is if you think about the Fed rate hiking cycle, since the beginning of the rate hiking cycle in 2022, all the way through to the end of 2024, on average, in any given quarter, the 10-year treasury moved in an 80 basis point range. And so what that's saying is at the beginning of the quarter, if the 10-year treasury starts at 4%, by the end of the quarter, it could be anywhere between 4.8 to 3.2. And that's a very wide range of outcomes. And in that wide range of outcomes, if rates fall by 80 basis points, prepayments could increase quite a bit. And if rates increase by 80 basis points, prepayments could slow quite a bit. As an investor, what that makes for is a lot of uncertainty in your prepayment forecast. And investors justifiably demand a premium for that in the form of wider spreads. And so volatility is driving market spreads. And if you look at what happened through 2025, rate volatility slowly came in through the course of the year. And we're at a point we ended 2025 at multi-year lows in rate volatility, both on a realized level and on an implied rate volatility level. And yet, given that low rate volatility, mortgage spreads were still wide relative to their long-term averages. What's happened recently is that the presidential administration instructed the GSEs to buy roughly 200 billion in mortgage bonds. That's about 2% of all MBS outstanding. And to put it further into context, it's roughly equal to all mortgage supply over 2025. So one buyer in the market is now taking down effectively the total net supply of mortgages. And what that's made for is significant spread tightening over the last couple of weeks. And now today, mortgage spreads look in the red of fair value, way more so than they did at the beginning of this year.
And what's really driving valuations and total returns for mREITs today, and how has that shifted over the last few quarters?
That's a great question. For commercial mortgage REITs, the biggest driver of both valuations and total returns is the spread between the interest income on the loans that they write and the interest expense on the cost of their leverage. And today, but it helps to take a step back to 2022. What started to happen is property values declined by about 20%, and a lot of borrowers were unable to make interest payments on their floating rate loans where they saw a 1-for-1 increase in their interest expenses. And so mortgage REITs on a portion of their loans were not able to collect interest expense, but were still paying interest expenses on their liability. What also happened at the same time is some borrowers just defaulted and handed the keys back to the mortgage REITs and they had to take over the asset. And because these are assets under transition, they're not fully stabilized, they're not fully occupied, and not cash flowing the same way as a loan would. And so the cash flow on the assets was under pressure, but the cash flow on the liabilities was still flowing. And that put tremendous pressure on earnings. What's happening in 2025 and is continuing in 2026 is that a lot of those underperforming assets in mortgage REIT portfolios are starting to get resolved. Their either fundamentals are picking up and they can refinance it to stabilize sources of capital, or mortgage REITs are taking those assets on balance sheet and carrying them leased out. So the cash flows on the assets are improving. And the interesting thing is the cost of funds on liabilities are starting to decrease now quicker than commercial real estate loan spreads are decreasing. And the last piece is they can take these resolved loans and the proceeds from them and reinvest them into new loans that are now optimally cash flowing. And so we're essentially seeing the other side of it. Cash flows on the asset side are increasing, but those on the liability side are staying constant. And you're seeing the earnings upside for that. We think commercial mortgage REITs will see double-digit earnings increases over the course of the next year and a half or so as they're able to install these assets going forward. On the residential mortgage REIT side, again, the big driver would be what's happening in the mortgage-backed security market. And so that's the big driver of total returns. You can think of these companies as being long MBS and short either treasuries or swaps in such a way that they're duration neutral and they're really earning just the spread between MBS and treasuries. And they're levering up that spread multiple times. So, given that they're earning just the spread, compressing spreads are good for their book value and total returns, and widening spreads are bad for their book value and total returns. A constant spread environment where spreads stay stable, they just were able to earn the spread that they went in at the beginning of the order. So as a residential mortgage REIT investor, what we want is either stable spreads or declining spreads for good total returns. And if spreads widen, you're going to see lower total returns today. And what happened all over 2025 is spreads were wide, but they were remarkably stable. And so that led for a very stable environment for mortgage REITs to operate in, but they were able to earn the spread without too much compression. And early 2026, we've seen a good amount of spread compression just at the start of the year, which again has been really good for residential performance up to this point. Today, spreads are a little bit narrower, closer to fair value, and it might be a more difficult environment for residential mortgage REITs to operate in. So if you think about 2025, total returns on residential mortgage REIT stocks were in the 40% range. They outperformed the Nasdaq and the S&P 500. However, if you think about that going forward, spreads are a bit lower right now, and convexity is worse than it has been. And so the risk return backdrop is still healthy, but it's not as great as it was in 2025.
And when you look at this point in the cycle, how do the risk profiles between commercial and residential mortgage REITs differ?
Quite different business models, right? And so for the commercial mortgage REITs, the big risk factors are either property value declines in commercial real estate asset values or a deterioration in fundamentals. So given that these REITs are taking business plan risk on the loans that they write, they're expecting a certain level of NOI appreciation. If NOI actually evolves to be lower than expectations, that's one of the bigger risks for commercial mortgage REITs. On the residential mortgage REIT side, really the big risk is changes in rates and rate volatility, which would lead to outsized prepayment risk in this environment. So if rates on the 10-year go down from 4% to somewhere in the mid threes, you'd see an increase in prepayment activity, and the negative could necessarily affect residential mortgage REITs.
And on the funding side, what capital and liquidity issues are top of mind for mREIT management teams today?
For the commercial mortgage REITs, in terms of cost of capital and liquidity, commercial mortgage REITs don't yet have a cost of equity that's conducive to external growth. And so almost all of their net growth in 2025 was funded with either repayments on existing loans or incremental leverage. Now, increasing leverage in a market environment where property prices are stable and the risk of a decline from here is fairly low is digestible for investors, and the commercial MDs have done well. But longer term, if the increase in leverage continues, that would start to be a balance sheet issue for commercial market REITs 2, 3, 4 years down the line. Liquidity wise, we're in a much better spot today than we were a year ago. Again, a year ago, we were seeing loans still getting delinquent, assets coming back to mortgage REITs on their balance sheet, where they're not optimally cash flowing, but you still have to pay interest expense on the leverage. That dynamic has stopped happening and is almost running in reverse. So liquidity challenges today are well below they were a year ago, and we're moving in the right direction. On the residential mortgage REIT side, we're almost firing on all cylinders, right? They have a good cost of capital on the equity side. And so getting liquidity from the equity market by raising more shares is a good option for them and is accretive to their. At the same time, the repo market, which they use as their primary source of leverage, is stable and liquid. And so they have multiple sources of liquidity today to finance their positions. But again, they're much more levered than commercial mortgage REIT. So this is a risk that, of course, always needs to be kept in mind for residential mortgage REITs.
And Harsh, finally, as you look ahead to the next 12 to 24 months, where do you see the balance between risk and opportunity for commercial and residential mREITs?
Again, for commercial mortgage REITs, the biggest opportunity is capitalizing on the attractive risk adjusted returns available in commercial real estate loans today. And so resolving their assets that are not fully performing and reinvesting those proceeds into new loans that are much healthier from a credit perspective, but are also cash flowing better is perhaps their biggest opportunity. In terms of risks, outside of a broad-based recession, the biggest risk for commercial mortgage REITs is the refinance markets dry up. So the CMBS issuance has been fairly strong. 2025 was a record year post GFC in terms of issuance. Banks are re-entering the market, and what that's making for is the legacy portfolio that was written pre-rate hikes for the commercial mortgage REITs. Those loans are now being able to refinance into stabilized sources of capital. If that flow stops and the refinance market experience some sort of hiccup, that will be a problem for mortgage REITs, because then they're going to have to keep the loans that were written at lower spreads versus today on their balance sheets for longer and push out that tagline where in which resolutions start to occur and we realize the earnings upside that's embedded in their portfolios. So that's the biggest risk for commercial mortgage REITs. In terms of residential mortgage REITs, on the opportunity side, if you look at the fixed income market today, the three big levers are duration, credit, and convexity. And out of the three, convexity still offers the best relative value, right? On the duration side, the curve has steepened, but it's not as steep as it has been historically. On the credit side, credit spreads are pushing more tech rights, but convexity still offers a healthy return. And so mortgages in that environment are still an attractive asset to have as a fixed income investor. The biggest risk for residential mortgage REITs is one that's everyone tries to forecast, but is impossible to forecast. That's a huge decline in rates that could happen for, one of so many reasons. So we don't try to forecast the direction or level of rates, but a few things that we're sort of keeping top of mind is what happens to the independence of the Federal Reserve later this year. How does the job market evolve? How that affects rates going forward. So keeping an eye on where rates are going will really affect the prepayment profile of mortgages and the convexity risk that these mortgage REITs eventually have to manage.
Harsh, thank you so much for your time today.
Absolutely.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.